Most people think banks make money in a simple way. They believe banks take your money, lend it to someone else, and collect the interest, but that explanation misses something far more interesting. Because in the modern financial system, banks don't just lend money, they actually create it. And once you understand how banks really make money, you start to see the financial system very differently. The basic business model. Let's start with the most familiar way banks make money. When you deposit money into a bank account, the bank doesn't simply store that money in a vault. Instead, it uses those deposits to make loans. For example, imagine a bank pays savers 1% interest on their deposits. The bank can then lend that same money to borrowers at 5% or 6% interest. The difference between what the bank pays depositors and what it earns from borrowers is called the net interest margin. This margin is one of the primary ways banks generate profit. Banks issue loans for many purposes: mortgages, car loans, personal loans, credit cards, business financing. Every loan generates interest payments over time, and across millions of customers, those interest payments add up to enormous revenue. But here's where the story becomes more interesting. Banks don't just lend the money they already have. Fractional reserve banking. Modern banking systems operate under something called fractional reserve banking. This means banks are only required to keep a fraction of deposits in reserve. Instead of holding all deposited money in cash, they lend most of it out. For example, if a bank receives $1,000 in deposits, it may only be required to keep a small portion available as reserves. The rest can be used to issue loans. Those loans then circulate through the economy, eventually becoming deposits in other banks. Then lend again. This process effectively multiplies the amount of money circulating in the financial system, and that leads to one of the most surprising facts about modern banking. Through lending, banks play a major role in money creation. But interest from loans is still only one piece of how banks generate revenue. Another major profit source comes from something many people use every day: credit cards. Credit cards are one of the most profitable products banks offer. Unlike mortgages or business loans, credit card interest rates are often extremely high. In many countries, credit card interest can range anywhere from 15% to 30% annually. This means that if a customer carries a balance on their credit card, the bank earns substantial interest payments. But interest is only one source of revenue. Banks also charge late payment penalties, annual membership fees, balance transfer fees, cash advance fees. Even small charges can generate huge profits when multiplied across millions of customers. And credit cards introduce another hidden source of income for banks. Every time you swipe a card, a transaction fee is collected. Transaction fees. Whenever you use a debit or credit card, the merchant processing the payment must pay a fee. These fees are called interchange fee. Part of this fee goes to the bank that issued the card. While the individual fee may only be a small percentage of the transaction, the volume of global payments is enormous. Billions of card transactions happen every day around the world. Because of this scale, payment processing has become a significant source of revenue for banks and financial institutions. But banks don't just earn money when you spend, they also earn money from fees charged directly to customers. Bank fees. Many banks generate large amounts of income through various service fees. These can include account maintenance fees, overdraft charges, ATM, withdrawal fees, international transfer fees. Individually, these charges might seem small, but across millions of customers, these fees generate billions of dollars in revenue each year. For banks, fees provide a reliable source of income that does not depend on interest rates or lending activity. Yet even this is not the full picture. The largest banks in the world operate far beyond traditional lending and deposits. Investment banking. Many large financial institutions operate investment divisions. This area of finance is known as investment banking. Investment banks help corporations and governments raise capital, issue bonds, and sell shares to investors. They also provide advisory services for mergers and acquisitions. In addition, many banks participate in financial markets by trading assets such as stocks, bonds, derivatives. Through trading profits, advisory fees, and underwriting services, investment banking divisions can generate enormous revenues. But perhaps the most surprising aspect of banking returns us to the earlier idea of lending. Because when banks issue loans, something unusual happens. Most people assume that when a bank gives out a loan, it simply hands over money that already exists. But in modern banking systems, lending actually creates new money. When a bank approves a loan, the borrowed funds appear in the borrower's bank account as a deposit. That deposit did not previously exist in the economy. In other words, the act of lending effectively increases the money supply. This process is a fundamental component of modern financial systems. Banks therefore play a crucial role not only in distributing money, but in expanding the amount of money circulating throughout the economy. At first glance, banking may seem simple. Depositors store their money, borrowers take out loans, interest is paid, but behind the scenes, the modern banking system is far more complex. Banks generate revenue through loan interest, credit card charges, transaction fees, service fees, investment banking activities, and through lending, they even participate in the creation of new money within the economy. Understanding how banks actually make money reveals something important about the financial system. Banks are not just places where money is stored, they are central institutions that shape how money moves, and even how it is created within the global economy.